marketplace centric. We're going to talk a lot about that and what that means. You're also an early stage investor, right? So you're placing a lot of investments in founders and companies that you like. And then, is that some of the thesis where you can place a wider variety of earlier stage investments and then, lean in on the ones that you want to take a bigger and bigger position in? Is that how you think about it? Is that always how you've gone about it?
No, it really stemmed from how I accidentally became a VC. So as you kind of highlighted or pointed out, I've been a tech founder and CEO for the last 25 years. I built my first big marketplace business in eBay of Europe back in 98. And by virtue of being a consumer-facing internet CEO throughout these years, a lot of other founders would approach me and say, hey, can you invest in my startup? And I thought long and hard, should I be an investor alongside being a founder and a CEO? Is it a violation of my mandate? Is it a distraction? And ultimately, I argued with myself, articulated the following thought that A, if I can articulate lessons learned to others, it makes me a better founder. B, if I can meet extraordinary founders and hear what they're doing, it keeps my fingers on the pulse of the market and makes me a better founder. And three, so it's okay to do it as long as it's not distracting, as long as it doesn't take too much time. And so I started by deciding I'm only going to do network effect businesses and marketplaces because those are the things I understand uniquely and innately. A, it's what I'm building. B, it's also what I studied in college, in market design and as an economics major. And I just need to create a process by which I'm going to be able to decide extremely quickly if I invest in startups. And so I became an angel and maybe became a super angel because of the volume. And by 2013, I had over 150 investments. It just turned out that when I left OLX, it's like building companies, like investing in companies. I partnered with my co-founder at FJ Labs, and we created, frankly, a family office to invest. And that started attracting the interests of other people interested in marketplaces. So we said, hey, can we invest with you? And that led us to becoming a VC. And so it's just a continuation of the angel strategy I was applying that became a VC fund. But that's why A, I'm an accidental VC, but B, I think what we do is angel investing at venture scale, which is part of that ethos of like, we meet a lot of extraordinary people. We want to back them because there's so many problems in the world that we want to fix.
You're investing in marketplaces all over the spectrum, B2C, product-oriented, service-oriented.
Actually, let me add one more point. So even though it's not a strategy to be prolific, it's not like at the outset, there is a lot of data that suggests that more prolific investors do better. So AngelList has done a lot of studies on returns of VC funds. And if you invest in all the qualified, and of course we can define what qualified means, startups, you do better. And the more diversified the portfolio, the higher your long-term IRR. And it's been definitely true for us, right? We've had 300 exits, we've made money in over half of them, and we have a 40% realized IRR on those exits. And diversification actually helps. But again, it's not the reason we do it, it's the results of what we do.
And as you said, it's worked pretty well. I think you're on your ninth fund. You're currently deploying out of 3 or 4 active funds right now.
So of real funds that are really LP backed, we're Fund 3. We just raised $290 million in Fund 3, but we've had a lot of these little AngelList mini funds where others have invested with us. And on that one, I think we're in 9th or 10th. And of course, I started angel investing back in 98, so 25 years ago. But yeah, the main funds were at Fund 3, and we're at the beginning of the deployment period.